Another thing where interest rates have a major impact is just the federal budget. So this slide, I know there's a lot of numbers here. The left side are outlays, what we're spending. So we expect to spend $5.7 trillion in 2022. We'll bring in receipts for about $4 trillion in taxes. So right off, we have a deficit of about $1.7 trillion. But let's remove the discretionary. So that's defense spending and non-defense, that's discretionary. It's not written in law that these have to be paid. There's still some wiggle room there. And then we just look at the mandatory, Social Security, Medicare, and Medicaid, other things that are legally required for the government to support, as well as their interest payments on their bonds. Now, we have a $30+ trillion national debt, and they're paying $305 billion in income. Or interest. That means there's an average interest rate cost for the government of about 1%. That's not a big impact. And if we looked at how long are those bond maturities, they're at about 65 months. Let's say that's 5 years. So that's 1% for the whole 30 trillion. Right now, a 5-year bond is trading at 3.4%. And if we just wait and stay at these rates, the maturities are going to roll off, and we're going to replace them with more expensive bonds. So if we get to 3.4, 3.5 on a 30-year, $30 trillion debt, that's going to be well over $1 trillion in interest. And once again, let's just look at that mandatory spending. We'll be at a deficit of $1 trillion before we've written a check for anything that's non-discretionary, any defense. So the Fed, as much as there's issues in the mortgage industry, if interest rates were to go this high, how are you going to pay for them? Because you can't tax. It would take a 43% increase in the receipts just to cover that deficit to say, okay, we're finally neutral. We're not adding the debt. Because every dollar that you add increases the interest payment. So what I think the long-term play here by the Fed, and I know in Jackson Hole, Powell said he wants to fight inflation. And I think they do want to fight inflation, but not so much to bring it down below 2%. What I think they're desiring is that GDP, because of inflation, is growing at a faster rate than what they're paying in interest, so they can basically inflate a lot of this debt load away. Because if they were to try to raise taxes, that's going to take it out of GDP and is going to compound the problem. So there's really basically one option they have, which is to try to let inflation remain above interest rates going forward. So that's one of the reasons that we've been hesitant to add a lot of fixed income or bond exposure, because we think interest rates are going to be below that inflation rate, and we're going to see anyone that holds that $30 trillion portfolio lose some of their purchasing power over time.